All right. Good morning, everybody. So we had a little bit of movement this morning with the ECB rate hike decision. They went with 50, and then they made some statements about continuing to hit with 50, higher for longer, basically, is the message. Their analysts, just as much as our analysts, continue to believe that inflation is going to drop off significantly within the next 2 or 3 quarters, and that the damage done by the Fed is going to cause a recession. There's different recessions, different calibers of the, say, like shades of gray. If you remember trying to work in 07, 08, 09 during that recession, that sucked. That was a bad time. There's mild recessions and strong recessions, and then there's historic ones. So far, everybody seems to believe this will be relatively mild. We'll see. But that's basically the reason for what we're seeing moving around this morning. We've got a pretty full house when it comes to who's on deck to speak today. European central bankers and US Fed members. Remember that February 1, we're going to have an FOMC meeting. So they're going to go into blackout period soon, usually 10 days before. And when they do that, you're going to want to keep track of this Nick Tamaros guy. He's got a Twitter account and often leaks when the Fed has something that they want to say, but they're in blackout mode. They will leak it through him. I don't know why. I have no idea what makes him the target, but that's what they do. So his Twitter handle is at Nick whatever. I always butcher the guy's name. Poor guy. You can find it in the Twitter package. Got him listed under Fed Whisperer. So keep your eye on this through the morning. The fact that we're down right now doesn't really mean too much yet. You got to kind of let it play out a little bit. We can see the market starting to base some. So we got Brainerd at 115. It's going to be kind of a later. That's going to get in the way of 0-day trades. Kind of keep your eye on that this afternoon. We have additional auctions today, and up to and including one at 1 o'clock, the 10-year tips. We have an EIA status report, which normally we would get those on Wednesday. But when we have short weeks, that thing gets kind of tossed around a little bit. We've seen a real shift yesterday in the energy space. So it's definitely one to keep your eye on. It's a full day. What you're not going to want to do on a full day like that is run those out of the money, far away credit spreads in the idea or in the hopes that price won't hit you. we could get a big move from any of those that could cause the market to, leg up or leg down and match a 3% move on the day. So unless we already move 3% and then you go out of the money, beyond that, if you're going to do a 0-day on a day with that much econ, you're going to want to do it at the money, near the money, or even in the money if you know that strategy, and not use the one that's out of the money, just so that you're not dealing with, risking 4 to make 1 kind of scenario. Flip that around and, risk 1 to make 4. Over the last 3 days, we had come in with really light volume. And I had mentioned that, due to the short week, probably what we were going to get. But that failed to take into account the ECB today, right? And just like when we have our own FOMC, light volume days precede it. Someone much smarter than me once said that the Fed is a volatility suppressor. And at first blush, that seems completely backwards, right? You would think that FOMC announcements and the Fed causes volatility, it doesn't suppress it. But it depends on how you're approaching it. As we get closer to FOMC, the market quits moving, right? It starts to coalesce and consolidate. If volatility is another word for movement and the market quits moving as we get closer to an FOMC, then the Fed is suppressing volatility. They're compressing it. So we had ECB showing up today. And before that event, we had low volume, multiple days in a row in this ECB timeframe, right? Because right now in Europe, it's 12:30. It's halfway through their trading day. This volume indicator that we're using on the bottom of the screen is looking at the overnight trading volume, not the intraday or anything like that. So it's not looking at what we do. It's looking at what Europe does. Europe was light on the volume for the last 3 days as they came into FOMC. Now they have reported, and we're sitting at around 150-ish. So you can see the very narrow muted range that we had this morning. The IB. Couple Busby attempts, and then the move to the downside, which took the rest of the market with it. We're only down 0.75%, not even a 1% move yet. The ADR half is at 39.11, which is a cog line. And then we have the ADR full at 38.77. Last week's low is at 38.90. So we got a couple of pivot points down there. We do have the potential to rebound up off of these lows. Right now, it's more of a idea of, are they going to start pricing it in here? Right, we are priced in for a 25 basis point rate hike. Remember, we talked about this the other day. So if they start pricing in a 50 instead of a 25, we're going to see this market sell off some more. We still have no shape in the 10-day, 30-minute volume profile. No classic forms. We left the point of control behind at 40.11, the other cog line. And you can see how first touch price tried to stabilize a little bit at this high volume node. It didn't stick, but it at least tried. That's the kind of activity that we expect, right? So, just keep in mind, these aren't support and resistance areas. They won't hold price. That's not what they're designed to do, but they might slow it down, give it a little bit of stability. First touch bounce reversals. You can run contrarian trade setups, but they're also destinations. Once we start getting close to them, we're almost destined to go hit them, right? Like a magnet. So we're getting through the last high node zone. Below that, it shallows out again and does not turn into another high zone until we get around 3860-ish. And it's not a very good one, right? 3860 area, it's not that hot. When we're at the top of the box, we expect to go to the bottom of the box. And when we're at the bottom of the box, we expect to go to the top. Now, I said that, earlier in the week. We're working our way down. Over the next few days, we're going to lose this volume here. And the bottom of this box will move up unless we break through that zone today and reprint down in this area. So we'll be at the bottom of the box by Friday or by Monday. Even if we don't get below 39.11, right? That's all it would take, is just for these candles to drop off. All right, we took out the VPOC. We don't have another one to carry forward from yesterday. Notice the significant level of volume down there at the lows yesterday. This is one of the reasons that we run a TPO and a volume profile combined. We're looking for significant levels of iceberg activity. It's the idea that we can spend a very small amount of time at a high or a low and yet find a very large amount of volume there. Institutions will kind of break things down into quadrants. And when we get to that quadrant, they just automatically activate whatever their system was set to do. This is kind of high volume, but it's not massive. It's not significant, considering we did spend, quite a bit of time there. We'd be able to quantify how much time if we were looking at it with a TPO, which is what this blue one is. The thing is, this is a 10-day, 30-minute. And if we wanted to look at what was going on yesterday or how much time we spent down here, we would need to put it on a chart like this, which is why you can use, on Thinkorswim, it's called monkey bars. On other platforms, it's a TPO chart. That would be using those ABC grids, and the volume profile kind of creates an odd shape chart, runs 30-minute bricks. Those would give you a clearer idea of how much time we spent in a particular area and how much transactions happened down in that area. This isn't enough, so I wouldn't go through the steps or the effort to dig up yesterday's. But if you ever needed to, that's how you would do it, right? Change your system over to the monkey bars and dig deeper into the liquidity at a particular area. Or use your book map, since Thinkorswim has that now. If you don't have this, it's because you have to ask for it. Go to support, tell them you want to turn on the free book map. They'll push some buttons, have you log off and log back in, and then you will have a book map for free. You get what you pay for. So the free one doesn't allow you to look at everything, but it will do the S&P and Apple and Microsoft. And I mean, that's pretty darn awesome. All right, some signals that stood out. Yesterday, we had that early green line cross, and the green line led the way to the downside. That was a check mark for trusting the move, staying in the move, and not giving up on it. We talked about this tick yesterday and how it had been indicating a crossover. Right, this was what we had examined, and we were at the low yesterday. We had that nice little pop up and then a rollover. NY Fang rolled over with finance. It's like a twofer. And the weighted AD really early pushed through -5, and that cyan line led the way. So we had some really clear signals on that move yesterday. And yet I had a number of people tell me they got ran over trying to catch a falling knife, trying to run long yesterday. I get it. It was worth a try, I guess, right? Counter trend plays, you can always try to go the other direction for a small move, but there was nothing signaling this thing was trying to come up off of the lows and make a reversal yesterday. In the morning briefing yesterday, I made it really clear the expectation was a pop to the upside and then a drop down to the 10-day moving average. It's what we were expecting. All right, we're still in the box. We're halfway through. So looking at this and thinking about, you know, the equity markets and anything that's going to be affected by the S&P moving up or down, we're in the middle. You don't want to diddle in the middle. If you're looking for swing trade opportunities with some heft behind it, some structure that's going to last a little while, we got to get out of this box. So we need to be above 4,100 or below 3,800. Now, the good thing is you can trade to those locations, right? We're headed to the downside. We're completing the swing. You could try to running it down to 38. But if you're looking for a good swing, kind of need to get out of this box. I've heard a number of analysts say this year is going to be the sideways year, right? That if you look back over the last decade, or better yet, look back at 07, 08, 09, when we had a recession, a bad economy, a bear market, and it took, you know, a year of stabilizing and basing along these lows before we finally turned around and began moving back up out of them. We are below the 10. We're nearly 1% below the 10. The turnaround average is about 2.5 to 3. So we've got a long ways to go before we even consider the idea that we might be overbought or oversold, right? To be overbought at 3+, be oversold at -3. We're nowhere near that. So if you think about the center of a basketball court, everything starts in the middle and you move to one side of the court or the other. The 10 would be the center of the basketball court. It's the mean, it's the middle. From the 10, we make an expansion above or beyond, below the 10, and we just keep coming back to the center of the court. So roll over, cross through, just like we did before. We're going to be looking for this to turn at some point and go back up. No turn yet. No reason to expect a turn yet. Looking at the 10-week, we're just barely underneath it. We haven't even gotten started. So plenty of room to expand beyond the 10-week. For the weekly expected move, there is an indicator that we use for this called the weekly expected move. And in a low volatility market, it does okay. It's not bad. But in a market with a lot of volatility, a lot of movement, it doesn't do that great. This is the range that was projected for the week. We're outside of that. If we had drawn it by hand, it would be much more accurate. The ES doesn't do too hot when it comes to that thing. It was designed to be used with the SPX. So just go over there and take a look at it. The SPX hit the range edge yesterday. And since we're opening up, down this morning more than 1% or near 1%, then we're going to be opening much lower than that. But again, this thing isn't accurate. It's not accurate in a volatile market. You need to draw them by hand. The data to draw them is here, but you needed it Friday, not today. So one way that you can do that is you can go to Think Back and take it to the 13th. And now these options up here reflect end of day data on Friday the 13th. The market closed at 3,999, basically 4,000. A 7-day move to Jan 20 had a $65 expected move plus or minus. Jan 20 is tomorrow. All right, so you could take that and hand draw it out on the chart. 65.4. Well, we already know it's 4,000 plus 65. So that'd be 40.65 to the upside. And then 4,000 minus 65. It'd be what? 39.35. Ballpark numbers. I'll say it got lucky. That indicator actually lined up pretty close to where my hand-drawn lines are, but it hasn't been that accurate for a while. So I'm going to just say it got lucky. I have a chart somewhere that has them already hand-drawn for years, and you can see how far off they are, but it doesn't matter. For today, we'll just stick with this. So we're outside of it. The reason I spent time bringing it up, measuring it out, plotting it out there is there is a market dynamic where the market makers will sell into selling. So if we expand too far outside of the 1 standard deviation expected move that they've traded against, they have to hedge their positions. So they start their positions with options. They build strangles and straddles on one of these two lines, right? The upper line or the lower line. Once they've done that, if we expand too far beyond that zone, that range, they will use the futures, which have a hard delta, and they will sell into selling to get back to delta neutral, right? Options have a liquid delta, futures and stock have a hard delta. It's a set delta that doesn't change. So when they need to increase or decrease their deltas, they do it in the futures. That level where they decide how far it has to go before they start selling into selling can often be a point of contention, a little bit of an argument. I've heard it say 2 standard deviation. Some have said, it's got to go more than 2.5. I think Spot Gamma does a really good job with that. They're using way more modern tools than a lot of the old school people that say it needs to move, 1 standard deviation, 2 standard deviation. They're using some off the cuff, old school metrics, and something like Spot Gamma uses a more right now, immediate. I don't even understand half the tools they use, right? They're definitely using a more modern system. The other point of that is if we do begin to stabilize and we're outside of the expected move and outside of that Spot Gamma range that we were talking about, the market makers will take full advantage of that and run it back up. We had a day not too long ago where something like that happened, and off the cuff, I'm going to say it was this day. I'm not 100% without going in and looking at the intraday, but I would know the day if I saw it. Market ran down deep into lunch, stabilized and paused. Volume kind of dried up. The pressure to the downside dried up, and market makers ran it back up in the other direction. Now, they didn't make it all the way back up to where it had opened, but they made a good run at it. And the gamma range that day was 1.29%. When we got beyond that, the selling really picked up because they have to sell into selling. So this move this morning to the downside, the effects of the ECB rate decision. If you are watching Finance Juice, you'll notice that it's not all negative, right? There's some positive data points coming out. All it's going to take is for the market to shake off this first blush move and start running things back in the other direction. Remember, nothing's changed. That 50 basis point rate hike from the ECB was already priced in. But the market didn't like that some members, were looking at 75. They didn't like the higher for longer. So the point is, we're not oversold. We don't expect that this is going to go up just because we've gone really far down. That's a really bad way to try to trade. It's the idea that if we expand too far beyond that expected move parameter, they're going to sell into selling. And if it begins to stabilize or base, it could really easy flip over and run back the other direction. Until then, you're not going to want to try to go the other direction. Don't try any upside plays until this thing builds another base. At this point, it's not looking like we're going to get a V bottom, right? So you're going to want an area where it pauses or consolidates. I tried to go long here earlier this morning because it was a pause area. It stopped, consolidated. It was a low risk trade. Didn't work. Let it stop me out. No big deal. Run a trend line breakover. Some generic trend line, looking for it to base on the other side of that trend line, make a move. Or you could measure out the entire move. Say from where we opened it last night to wherever the current low happens to be, and use the first line. Depending on which way you drew it, it'd be 786 or 236. Look for it to get above that. It's part of my failed flag trade strategy. Now you could use something like a 5-minute 50 period moving average or a 5-minute 20. Look for it to get above that. Use a 20-50 cross. At this point, the selling is soft, right? There's no fear and chaos, and it's not uncontrolled selling. It's very neat and orderly and normalized. So there's not a whole lot of expectation that it's just going to continue to sell off. Not yet. It's not a surprise that things are down this morning. It's a little bit more of a surprise that some things aren't down more, like KWeb. KWeb is basically flat this morning. I would have expected it to be up or down, not flat. So that's a little bit of a surprise. It kind of goes to the argument that this sell-off may not just sell off all day today. And emerging markets is down, but negligibly, right? A minor amount, not even enough to register on our scale, because we want plus 0.5% or minus 0.5%. Fifty 50% of the S&P is down 0.5% this morning. Financials are leading the way with the biggest gap. Then the automotives, Ford, Tesla. Mainly, it's the financials. Not much of a surprise, though. And then, of course, we got the chip names thrown in there. And even though energy is getting a little bit of a turn. You got to keep in mind it's a basket of stocks, right? So energy stock can go down even when we're looking at, the energy space or the energy sector doing good, especially say like crude or coal or, pick your energy. We've got WTI and Brent crude in these two lower charts looking really good on the hourly. Nice reversal, basing pattern. Keep in mind, Europe closes right around 10:30 our time. So we could also be getting one of those midday reversals where we get through lunch or we get in close to lunch around 10:30, 11, and we quit falling, start to base, stabilize, flip over, and run back the other direction after lunch. All right, 27% of the S&P is down more than 1% this morning. Major banks, semiconductors, some oil and gas. So financials, monsters of tech, couple of automotives and semis are the worst hit. Flip this over to the NASDAQ. %45 of the NASDAQ is down at least 0.5%. Semiconductors seem to be getting the brunt of it. And biotech getting the worst of it. One of the things to keep in mind is if we do get this midday flip, things that are down the most are very likely going to be the things that you would want to target for a move back up. 31% of the NASDAQ is down more than 1%. Now, these numbers are not really bearish, and that's kind of part of the argument for why I'm saying there's the potential for a reversal today. Although yesterday wasn't much better when it comes to high correlation coefficient, right? Like how many names yesterday were going to the downside. Market breadth wasn't that bad. I mean, sure, it was down, right? There was no argument there, but it wasn't like 99 out of 100 names were headed to the downside. And we kept getting this diversification between tech and finance. They just weren't in sync, which is not a bad thing, because if they had synced up, we'd have moved much farther yesterday. Well, it's the same thing today. There's like a capital rotation going through the system. So instead of everything being down, we're seeing a rotation out, which is different. So then we can just kind of figure where are they going. All right, we're looking at the Dixie here, the DXY. Kind of hard to believe that we're going to get some kind of reversal at this point. We're not on, any critical level, other than if I was to expand the chart and start looking at multi-decade stuff, then we can kind of point out the 102, 101 area as like a major level. Start looking at it in quarters. You can see we got a bit of a Busby here. Same thing with US dollar Japan. Now, the big move that we see here, that was their decision to hold the line and not expand their yield control even wider than they already have. Since then, it reset the move and has just kind of stabilized. If this doesn't dump, then it's likely that the dollar isn't going to dump. And you can see we're getting back into the box. So we're going to be looking for a little bit of overshoot here today. See if it's going to stabilize anywhere between where we're at and call it 38.90, this low back here. That'll be its last chance to stabilize and bring itself back out of that box. If it doesn't find stability at that 38.90 area, calling it like a little bit of an overshoot and then coming back up, then we're 100% back in the box, and we're going to have every expectation that we go to the bottom of the box, 3,800. But at the moment, we can't say that that's the move because we overshot before and we found a little bit of stability right in this area. So that's what we're going to be looking for. If that fails, we're headed to the bottom. But we got to fail through this first. Otherwise, we could just overshoot into the box and come right back out again. So a little bit in the China space, PDD, JD, possibly Baidu, Baba, maybe Neo. They're going against the grain, kind of bucking the system. You want to keep your eye on those, even if you have no intentions of trading them. Right now, we've got a bifurcated market, right? We were just looking at it. Only 50% of the market is down 0.5%, right? So that means the other half of the market isn't down that much yet. If they all start heading to the downside, you're going to get a much higher correlation coefficient. We're going to break levels and continue to expand lower. If this dichotomy starts to widen out and we lose less names that are headed to the downside, we start turning things around, that midday V bottom or midday base with a reversal off the lows becomes much more likely, especially when we have econ today all day long, including auctions at lunch. So we have the potential for a flip event. This is why a 0-day, when you have this much econ on deck, can be a little tricky. When I first started trading, I looked at a grid like this and I thought, well, this is stupid. What a waste of time. It really isn't, though. These are really useful, really valuable. At a glance, you can see what's going on in 100 names. It's easier than looking at a watch list. It's just a nice, simple, easy visual. What you're going to want to keep your eye on are these gray areas, if they join in with the red, and the green areas, if they first start turning gray and then turn red. Otherwise, start looking for a lot more of these reds to turn gray and then to start turning green. Same thing with the S&P. We got some consumer names, Coke, Philip Morris. I think that's Comcare or Comcast hiding over there. Oh, no, it's Philip Morris. What is that? Ultra. Apple being down more than 1.25% is a big one. We're going to need that to quit falling. It doesn't necessarily have to rise, but it has to quit falling if we're going to see that market reversal this afternoon. And for the fall to get worse today, keep your eye on Microsoft. If this really starts to expand lower, when we've already got the other monsters of tech down more than 0.5%, more than 1%, then the selling could really increase in velocity, right? The rate of change could get much steeper. And then we're going to have to really worry about the market makers selling into selling. Tesla down 2.25, nearly 2.5. Apple more than 1. Nvidia 2.5. Facebook more than 1.25. Right? These are the monsters of tech, and if they all get into sync and start heading to the downside, and we don't have financials to back us up, then the selling could really pick up speed. Bonds continue to look a lot better than the S&P does. But right now, they're getting whacked just as much as everything else. Focus on a trend line breakover. Don't have to get too precise with that trend line, right? Just kind of snap it along the lows. You're looking for the same kind of situation as here, right? It's just a smaller version of this. So a little bit of a basing pattern, a solid break. In the move back to the downside, 50% is going to be the level of on watch. Right? So we need to stay above 104. Just like with this pullback here, it went too deep. So it's going to kind of prove me wrong here. In general, we don't want to see these pull back more than 50%. But when we're looking at it on a daily chart, that's what matters. Like, did it close below that level and then come back up? Because generally, if we get it closed below that, we're not going to make it back up. we're going to retest. Sure enough, we did on a daily. We closed below that and still came back up. All right. Still what we're going to look for here. All right, we got the VIX waking up. It made it back above 21. If we're going to get that midday reversal, we got to see the VIX kind of back away from this move back up again. That may or may not come with the dollar. The dollar can just hold still. That's really all we need. But if the dollar continues to expand up off of those lows that it set yesterday, it's going to make it hard for an argument to see an upside move in the S&P this afternoon. So really that's it, guys. Got to keep your eye on the low today. That 3,900 in the ES, 3980 or 3890. We have to catch bid and begin to stabilize around that area. Now, keep in mind, we can overshoot that a little bit, right? We can wick through, get a little bit lower and come back up inside again. But if we get a definitive break below that pivot, below this little pivot right there, then we're very likely going to go down to 3,800. So put that on a normal chart. That would be January 10, the low from Jan 10. All right, everybody, be careful, be safe, have a good day. Watch the clock today. I can't stress it enough. Watch the clock. Keep your eye on finance juice because any of these Fed speakers can come out and kind of turn this market around, right? I don't think that they will. It's not their goal to make the market go up. And there's no reason to activate the plunge protection team. So I don't see any that they're going to come out and defend anything. I'll see y'all tomorrow.